Your boomer relatives earned around 12% a year through the 80s and 90s. They tell you to invest in stocks, and they are not wrong to. But your millennial friends spent their first decade as investors riding through two of the worst crashes in modern memory. And Gen Z walked in when the market was sitting at all-time highs. Same advice, handed down with total confidence. Completely different math running underneath it. Same plan, four very different endings. Today, we put four generations side by side and run the exact same contributions through each one. The reason this trips so many people up is simple. The 10% historical average you always hear is real. It is just that an average hides everything that actually decides your outcome. It hides which decade you started in. It hides how expensive stocks were on the day you first bought. It hides the order your good years and bad years arrived in. Two investors can follow the identical plan, buy the identical fund, contribute the identical amount, and still walk away decades apart in wealth. So to keep this honest, we hold everything constant. $500 a month, every month, into a plain index fund. Only the era changes. By the end of this, you will know exactly why the same strategy produced outcomes more than $1 million apart, and the one adjustment that makes it work no matter when you were born. On this channel, we run the actual math. On the surface, the advice looks bulletproof. Just buy index funds, they say, and it sounds like the one piece of money guidance everyone on Earth agrees on. The 10% historical average gets repeated so often it starts to feel like a promise the market put in writing. And following the investing advice your parents give you feels like inheriting proven wisdom. Because for them, it genuinely was. Their accounts grew. Their houses grew. The plan worked exactly the way they said it would. So when a younger investor follows the same steps and the numbers come back smaller, the natural conclusion is that they messed up somewhere. They picked the wrong fund. They started too late. They panicked at the bottom. Almost none of that turns out to be true. Here is what the average is hiding. Where prices already sit on the day you enter shapes your returns more than almost any choice you will ever make. There is a measure for exactly this called the CAPE ratio. It is basically how expensive stocks are compared to a full decade of their actual earnings. In 1975, that number sat around 8. Stocks were cheap, almost unwanted. By the peak in 2000, it touched roughly 44, the most expensive the market had ever been. And today it sits near 40, the second highest reading in over 150 years, just under that dot-com record. The higher that number when you buy in, the lower your future returns tend to run. Your boomer relatives invested well, sure, but mostly they bought a sale almost nobody else recognized. So if your portfolio looks nothing like the brochure, the explanation is almost always timing. You entered the market at a different point in history than the people handing you the advice, and that single fact explains most of the gap. The boomer return that gets quoted at every family dinner was part skill, and mostly luck of the starting line, a once-in-a-lifetime entry point that happened to line up with the greatest bull market this country had ever seen. Nobody engineered that. They just happened to be standing at the door when it opened. Let us actually run it. These are illustrative worked examples, round numbers picked to show the mechanism, not forecasts for your account. Start with the boomer. $500 a month from 1975 to 2005, earning roughly 12% a year, which is close to what a plain index investor really got across that stretch. That account grows to about $1.75 million. Now, Gen X, starting around 1990. Same $500 a month for 30 years, but the return environment cooled to about 10%. They still rode most of the 90s boom, then took 2000 and 2008 on the chin. They land near $1.1 million. Now the millennial, starting around 2005. $500 a month for 30 years, but call the realistic blend 7%, because they began closer to full prices and the road ahead from here runs lower. They land around $610,000. On Gen Z, buying in right now at a CAPE near 40. From valuations this stretched, a 5 to 6% blend is the honest planning number. 30 years of $500 a month lands somewhere around $420,000 to $500,000. Same contribution, same fund, same discipline. A staircase that drops by more than $1 million from top to bottom. And here's the part most people get backwards. The two big crashes the millennial lived through, 2008 and 2020, were not the villain. When you are still buying every month, an early crash is closer to a gift, because your money scoops up cheap shares that recover later. The real drag is not the crashes. It is starting from prices so high that the math has less room left to grow. So why does that 10% number never seem to die? Because it is the most optimistic figure available, and an entire industry has a reason to keep it on the poster. Fund marketing leans on best-case historical data, because a bigger number moves more product. The success stories you hear are the ones that survived, and they get told and retold, while the flat decades quietly vanish from the pitch. And most advisors will gladly show you what the market returned over the last 90 years. Far fewer will sit you down and walk through what valuations this high suggest about the next 10. The optimistic story is simply easier to sell than the honest one. Now, in fairness, the people pushing index funds are mostly right, and it is worth saying that out loud. Time in the market really does beat trying to time it. Almost nobody calls the top and the bottom correctly twice in a row. Contributing every single month in the good years and the ugly ones genuinely softens the blow of any one bad stretch. And spreading your money across the whole globe, instead of one expensive market, gives you a shot at the cheaper valuations sitting overseas. The core strategy holds up across every generation we are looking at. The only thing that changes is what each generation should realistically expect to get out of it. Let's check the scoreboard. The boomer, investing in the ideal window. $500 a month for 30 years at about 12%, ending near $1.75 million. Gen X, a decade behind. Same plan at about 10%, ending near $1.1 million. The millennial starting closer to full price. Same plan at about 7%, ending around $600,000, and Gen Z buying in at the second most expensive market in history. Same plan at 5 to 6%, ending around $420,000 to $500,000. Top to bottom, that is well over $1 million of difference on the very same advice. But notice what never changed across all four: the fund, the discipline, the monthly habit. The only real lever still in your hands is the one nobody likes to hear about, which is how much you put in and how honest you are about what it will earn. So here is the rule to carry out of this. Low-cost index investing is still the correct strategy, full stop. The returns your parents earned were part skill and mostly timing, and you cannot inherit their starting line. So plan around 6 to 7% and treat the 10% on the poster as fiction. Build your whole plan on the number you are actually likely to get, and let anything above it arrive as a pleasant surprise instead of the thing you were counting on. Here's what actually works. First, keep buying low-cost index funds. The vehicle was never the problem, and switching strategies now would only cost you. Second, build your plan around 6 to 7% a year, so a great decade feels like a bonus, and a mediocre one does not wreck you. Third, raise your savings rate to cover the difference. If the market is going to hand you smaller returns, the contribution is the piece you control, so push it as high as you reasonably can. Fourth, spread your money internationally. Do not stake your entire future on one market that is already priced for perfection. The cheaper valuations sitting overseas are part of how you protect the whole plan. And once you stop expecting your parents' returns, something strange happens. The plan finally feels honest. You are building on real numbers instead of a brochure. Next time, we put 1985 and 2025 right next to each other and look at the house your parents bought. Because the same forces that sent their stock soaring sent their home through the roof too, and they may quietly do the opposite to yours.